Now, the next item on the list is reasonable compensation. Let's talk about this one for a minute. Now, I already covered reasonable compensation in depth in the video I made regarding S corporations, which I'll link down in the video description below. But on a very basic level, if you're an S corporation shareholder and you provide services to that S corporation and you're pulling money out of it, there is a portion of that money that you're going to need to take as salary or wages or payroll, whatever you want to call it. And the rest you can take as what are known as distributions. All right, so there's going to be reasonable compensation and distributions in most cases. And what can happen is that given that distributions are favorable from a tax perspective, meaning that they're subject only to income taxes, not to Social Security or Medicare taxes, S corporation shareholders are generally tempted to say, oh, well, listen, S corporation made $1 million this year. I pulled out $1 million, and 10,000 of that is going to be salary, and the rest of it is going to be distributions. That doesn't work. IRS hates when there's abuse in this area, and it's very common audit area as well because there's a lot of abuse that does go on. So with that said, you have to figure out what your reasonable compensation should be given your level of expertise, the type of service that you provide for the S corporation, the level of experience that you have, what kind of advanced degrees you bring to the table, and so forth. And reasonable compensation is really as individual as a fingerprint in many cases, depending on what the nature of the work is, what the nature of the company is. So that's why it's prudent to, in many cases, have a reasonable compensation analysis done before you even start the S corporation so that you can understand what portion of the monies that you take out of the corporation are going to be salary versus distributions. So that's going to also enable you to structure payroll throughout the year because then you'll know exactly how much reasonable compensation you should be taking. So while the tax laws require that reasonable compensation be taken, they never specifically define it. Instead, there's a list of things to take into account when calculating reasonable compensation, but there are no definitive numbers that say you're a carpenter, you should be taking X as salary, and you're a lawyer and your reasonable compensation is Y. So that being the case, it's important to take into account the individual situation that you're in, determine the reasonable compensation, structure the payroll that way, and go from there. So what you really want to avoid is a disproportionate amount of payroll to distribution. So basically, if you're taking 100 grand out of your S corporation and you're trying to make the case that 5,000 of that is salary because it's not preferential from a tax perspective, and 95,000 is going to be distributions, which is preferential from a tax perspective, you're going to have a bad time, okay? The IRS hates when this area is abused, common audit area, and you're asking for trouble. So after the reasonable comp analysis is put in place, let's say for that 100,000 of net income before the owner pays themselves, maybe 75,000 of that is going to be reasonable comp and 25,000 of that is going to be distributions. So that 75,000 number is going to allow you to take payroll throughout the year, which is going to be on that Form W-2, which is going to be your salary, wages, what have you. And then it'll also allow you to structure your distributions throughout the year. So although it's not required, it's generally a smart step to take to have a reasonable comp analysis in place so that if your reasonable comp is ever questioned, you can point to the analysis and say, hey, we did our research, we did our homework, and you can make your case that way. It's not necessarily going to mean that the IRS is going to agree with it, but in many cases, you're much better off having that analysis done because then you have at least a third party letting you know what your reasonable comp should be, and that's not a decision that you just woke up and made the morning of your S corporation election. There was more due diligence put into the process. So not a requirement, but it's a smart thing to do to get a reasonable comp analysis done for your S corporation. All right, now that we've talked about reasonable compensation, I'm actually going to skip item F for now, and we're going to go straight to item G and talk about income tax estimated payment projections. Okay, we'll go back to item F, no worries. But for now, I want to talk about estimated tax payments because we just talked about reasonable comp. And let's go back to our example where let's say you have 100,000 net income, 75,000 of that is salary, and then you have the other 25,000 that is not salary, that can be distributions essentially, that whether or not you take that money out of the S corporation, it's still going to be taxed at the personal level for you. So anything that's not expensed as salary, that's going to come through as net income on the Schedule K1 that you receive, which is going to be part of Form 1120S. So let's consider an example of an S corporation with $500,000 in net income before the owner pays themselves. And let's also assume a salary of $250,000, which represents that reasonable compensation aspect. That leaves $250,000 roughly. There are going to be some adjustments for employer portion of payroll taxes and so forth, but let's just assume that the remaining $250,000 is going to flow through on Schedule K1. Now, if this individual had taxes withheld on their reasonable compensation, but not enough to cover all of that additional income that's going to be included on their return through Schedule K1, then there's going to be a difference between what they had withheld and the total tax liability for the year. All right, and that difference needs to be bridged with estimated tax payments generally. And the due dates for those are April 15th, June 15th, September 15th, and January 15th of the following year. So for tax year 2019, the estimated tax payments would be April 15, 2019, June 15, 2019, September 15, 2019, and January 15th, 2020. So if estimated payments are not made in a timely manner throughout the year, based on that $250,000 that flows through on Schedule K1, there may be penalties and interest that are assessed. So it's important to take into account, once you know what your reasonable comp is, the amount that's actually going to flow through on the Schedule K1, you want to make sure that at the personal level, you're paying enough in withholdings and estimated income tax payments at that personal level to make sure that you can be as close to break even as possible when it comes time to file your return, because otherwise there can be a big difference between what you had withheld on your paychecks, what the total tax liability is, and bridging that gap may result in taxes and penalties when all is said and done. So the best way to approach this is, once you have your year laid out in terms of the estimated income, the estimated reasonable comp that you're going to take, and so forth, you should have an idea of what amounts are going to flow through on that Schedule K1. And then your tax professional should be able to guide you with regard to what estimated payments should be made and when, and you'll take it from there. But at a very basic level, you do want to keep track of that flow-through income and know that that is going to likely affect your tax liability. And that's something that I commonly see as a surprise to first-time filers of S-corporation returns, is that they feel like everything's going to be handled at that S-corp level, and they neglect to take into account that there are going to be personal income tax implications as well based on the flow-through. So very important to keep in mind, and you definitely don't want to lose track of estimated income tax payments. The other thing is that for California purposes, it's not 25% on each quarterly payment date that they want. No. California always has to be different. So for California income tax purposes, on that first payment date, meaning April 15th, 2019 for 2019, you're looking at 30% that's due, not 25. On the second payment date, meaning June 15th, you don't owe 25% of the total tax liability for the year. No. It's 40%. Don't ask me how they came up with it. So first payment, 30%. Second payment, 40%. Third payment, which is due by September 15th, is 0. All right? And so basically on September 15th, you would need to make an estimated payment at the federal level, but not at the California level. There's no payment due essentially that date. Then in January 15th of 2020, which would be the deadline for the payment of the final estimated payment for tax year 2019, then California would want another 30%. So it goes 30, 40, 0, 30 instead of the federal 25% every quarter. Kind of nuances involved there, but it's important to keep track of because that's what the rules entail. All right, so that's estimated income tax payments. You want some projections to be put in place to know where you stand and make sure you can make those payments throughout the year. Now, let's go back to the S-corporation franchise tax, all right? Now, the whole idea with having a flow-through entity generally is that the income tax implications flow through to the individual to be handled at the individual level. From the federal perspective, that is the case because you're going to have the tax implications for the most part from an income tax side handled at the personal level. So $100,000 of net income on the S-corporation level will flow right through generally to the individual to be handled on their personal returns. California, not quite the same. And the way the franchise tax works is that it's essentially a tax on the net income of the S-corporation with an $800 annual minimum. So what that means is once you calculate the net income for your S-corporation, then you're going to face a 1.5% annual tax on the net income with a minimum of $800. So at the very least, you're going to pay $800 even if your net income is zero or negative. But if your net income is high enough, then you may pay more than that $800. Now let's calculate the cutoff point for when you start to exceed the $800 minimum. So if we take 800 and we divide that by 0.015, we see that at $53,333 of net income at the S corporation level, then you start to exceed that $800 annual minimum tax. So what essentially happens is if you, let's say, have $60,000 net income at the S corporation level and you take 1.5% of that, now you're at $900. Okay, so you're no longer paying $800, you're paying $900. Let's say the net income is $500,000. Let's just see how quickly this can add up. All right, so now you're paying $7,500 to California on the S corporation return. Even though it's a flow-through, even though the idea is that the income tax implications should be handled at the personal level, for California purposes, that's not exactly the case. The net income is going to be subject to this tax. So the distinction here is for California S corporation franchise tax, the $800 minimum is applicable for every tax year except for the first year. There's a first year exemption for that $800 minimum. It's not an exemption from the 1.5% annual tax. So what that means is that, let's say your net income in the first year is $20,000. Now we take 1.5% of that, $300. In the first year, you'll be able to just pay the $300 for the S corporation franchise tax, not the $800 minimum. But for every year subsequent to the first year, you're going to have that $800 minimum. So even if you have, let's say, $30,000 in net income times 0.015, you get $450. You're going to still pay $800. All right. So that's an important fact to understand. There's an $800 minimum that's applicable for every tax year except the first year. And if you have net income of over $53,333, it's going to add up to more than that minimum. So you definitely need to keep an eye on what amount you owe. It's not just going to be the $800. Now, where is this amount calculated and how does all this work? All of the magic happens on Form 100S. Let's take a look at what that looks like. So here we have Form 100S, which is the S corporation income tax return at the California level. And this form is quite a bit more involved. We're not dealing with the SS4 anymore, statement of information. Now it gets pretty hairy. And as we work through this form, you can see that in this tax section here, this is where the annual tax is going to be calculated. So generally 1.5% of the net income with an $800 minimum, except for the first year. The $800 minimum is not applicable for that first year, but you still have to calculate the 1.5% annual S corporation franchise tax for California. So that's where the magic happens for that. And it says here, newly incorporated or qualified corporations are not required to pay the minimum franchise tax in their first year. However, the 1.5% annual franchise tax is still applicable for the first year and is calculated based on the net income of the S corporation. All right, so let's take a look at the instructions for Form 100ES, which is the form you'd actually use to pay the $800 annual tax. Now, here's an important distinction to keep in mind with regard to the payment of the franchise tax for S corporations. It says here, if the amount of the estimated tax does not exceed the minimum franchise tax plus any Q subannual tax, don't worry about that for now. So we're talking about the $800 minimum. Then the entire amount of the minimum tax is due as an estimate on or before the 15th day of the 4th month of the corporation's taxable year. So what they're saying is if you're going to owe less than the $800 minimum, then you just have to pay the $800 minimum by essentially April 15th if you're using the calendar year. So let's say that your total franchise tax liability at the S corporation level is going to be $1,200 for the year. Based on that, your first payment would be 30% of that. So let's take a look. Would be $360. But California doesn't want $360 on the first payment date. They want a minimum of $800, and that's got to be paid by April 15th of that first year. So if we have $1,200 total, we have to pay $800 on that first payment, and then we have $400 to worry about for the rest of the year. But they do want the minimum of $800 paid by April 15th. Very important thing to keep in mind there. And the rest of the amounts can follow this payment schedule, being 30% for the first required installment, 40% for the second, no estimated payment for the third, and then 30% for the fourth installment. California has to be different. That's life. That's how you can handle the payment of the S corporation franchise tax. Now again, the whole idea of S corporations is that they have flow-through treatment so that the income tax implications are handled at the personal level, but California has to make things difficult, and that's what it is. All right, now moving along, we talked about item G, so let's skip directly to item H, which is business license or business taxes. Depending on where your business is located, where you conduct your business, and so forth, you may be required to file for a business license or pay a business tax. Specifically in LA City, where I'm located, they have the LA City business tax. So if you had an S corporation here, you would need to register for a LA City business tax certificate and also pay the LA City business tax, all right? And this is applicable wherever you're located. So if you're in a particular county, particular city, you do want to do some research to make sure that you're in compliance with the local rules and regulations, then that any applicable taxes are paid in a timely manner. So for LA City business tax purposes, you'd go to the Los Angeles Office of Finance, and on this website is where you can register for a business tax registration certificate. So this can actually be done online, and it's a pretty straightforward process. And this essentially gets you on the radar of LA City and will allow you to renew the registration and pay the applicable tax on an annual basis going forward if it's applicable. So that's pretty straightforward process there. So you want to make sure that you adhere to the applicable rules and regulations pertinent to the county in which you work, the city where you work, etc., because there could be different rules at each one of those levels. Now let's talk about sales taxes. Now it's crucial to stay on top of your sales tax requirements because whereas income taxes are based on the net income from the business, sales taxes are generally based on the gross sales amount, so the numbers tend to be a lot higher in terms of taxes, penalties, and interest. Now, as an example, from an income tax perspective, if you have $100,000 in income and $95,000 in expenses, then income taxes are generally assessed on that $5,000 in net income. And also penalties and interest, if they're applicable, would be based on that amount as well. On the other hand, with sales taxes, you're generally looking at the entire $100,000 gross sales amount. So that being the case, the taxes, penalties, and interest tend to be that much higher. Sales taxes are not concerned with the expenses applicable to your business. It's based on the gross sales amount. And the position that you really want to avoid is having to pay sales taxes but not having collected them from your customers, all right? Because that can be extremely costly. And being on top of your sales tax requirements from the very beginning will allow you to avoid that hassle. And last but not least is the anything else category. Now, whatever business you're in, there's a good chance that there's some sort of rule or regulation at the local, county, state level that you need to keep track of. And now this may be a license, a permit, what have you, but it's really important to do at least the Google search of what kind of business you're looking to form and the location to see if there are permits or licenses that you need. Now, let's take Elon Musk, for example. He has the Boring Company, right? So they're making tunnels under the surface of the earth. I'm pretty sure there's some licenses that are involved to allow for that to happen. So certainly there's rules and regulations applicable there. On the other hand, let's take a look at Tesla, right? So automotive manufacturers are pretty much known to deal with mountains and mountains of rules, regulations, bureaucracy, and the amount of legislation they have to get across is completely unbelievable. And aside from that, you have SpaceX, right? They're launching rockets into space. So I'm pretty sure that you need at least a permit or a license in that regard, right? You can't just start launching rockets from your backyard. So that last category is a catch-all for anything else that would be applicable. And who would be able to guide you in this regard? Probably an attorney who's well-versed in the area of business that you're looking to start in your particular area. They'd be able to advise you on any applicable permits or licenses or so forth that you may need to keep track of. So the point is there could be requirements applicable to your business that are not related to income taxes that you need to take into account. So certainly don't skip this step. Do your due diligence because at the end of the day, as the business owner, you're most likely going to be responsible if any problems arise from the failure of meeting any rules and regulations. So make sure you don't forget to take this into account. So that was an overview of the tax implications of forming an S corporation in California. Now hopefully this video helps shed some light on some of the applicable rules and regulations and things to keep in mind when making the S corporation election. So if you enjoyed this video, feel free to leave a comment, like the video, subscribe to the channel, and be sure to hit that bell icon to be notified of future videos as soon as they're released. With that said, hopefully this was helpful. Thanks for watching. It's going to be the 550 plus 800, 1350.